Attendees are in listen-only mode.
All right. Well, welcome everybody. My name is Brian Coester. I'm CEO of Coester Valuation Management Services. We're a national appraisal management company in Rockville, Maryland. On the phone, I have with me the great Rob Chrisman. How you doing, Rob?
Well, aside from that mislabeling, I'm doing fine. How are you doing?
Well, there you go. There you go. Hey, everyone knows you. Everyone loves you. So, hey, thank you, everyone. This is for joining us as part of our Coester VMS webinar series. We try to do a webinar to provide value and information to all of our clients, and Rob's always been great to deal with. If you're not familiar with Rob, make sure you go check out his website, robchrisman.com, legendary commentary of what's going on in the housing market, and something that I've read and subscribed to for many, many years. So the great thing about this webinar is all the questions, all the information has been by our customers and or our people who follow Rob. I know Rob publishes in his articles, so that you get answers from the source and the man himself directly. So Rob, without wasting any more time, let's get right into it. What do you expect this spring in housing?
It's going to be a disaster, Brian. The whole industry is going to hell in a handbasket. The industry is going to collapse. Real estate values are going to plunge. What else do you want to talk about? No, I'm just I had to say that. I'm asked that a lot, and understandably, people are nervous. They're nervous about values. They're nervous about their companies. They're nervous about their jobs. They're nervous about the CFPB and the regulatory environment that's out there. But there's reason for that. But generally speaking, I'm hearing some very good things out there. I do have a chance to travel around and visit with some great companies, some great people, and I would say that overall the mood is very good with folks. When you talk about the industry and housing, and specifically when I talk to realtors, and I talked to a realtor group last week. They are mostly concerned about inventory, and they are concerned. This group happened to be just south of San Francisco in a town called Palo Alto, which is where Stanford is, where a lot of the high-tech industry is, and where also they've seen a fair amount of all-cash buyers in recent years, especially from China. And during our meeting, the discussion turned to all cash buyers in China and what the atmosphere was like. And I will say, surprisingly enough, they've seen the all cash overseas buyers plunge in recent months based on what the Chinese stock market has been doing. So that could influence values, or I should say influence inventories on the West Coast. Coming up, and depending on what happens in South America, that'll influence places like Texas or Florida and the East, in Europe as well. But at least on the West Coast, the values continue to be good, but there is this nervousness out there, this talk of a real estate bubble and so forth. But overall, I would say spring buying season is coming up. I'd say realtors are hopeful out there that some of the inventory will get jarred loose. Building has picked up in many areas, so that's good. The increase in construction and construction spending is noticeable, although builders are having a bit of a problem finding good land that's near some of the urban centers that folks want to live in. But overall, I'd say things are pretty good out there right now.
Yeah, and the cash buyers is something that I've often looked at being on the appraisal side, is that there is, whenever the cash buyers is higher than, I think the national average is in the high 20s, but it got up into the the mid 30s at one point, and whenever it goes back down, it's a good indication of the market starting to recover a little bit and prices increasing and stuff. So thank you. Do you see a lot of CFP enforcement actions coming this year, I guess I would say?
Well, that is a terrible way to run an industry. I'll tell you. I mean, that's just my opinion, and of course, Richard Cordray thinks differently. But for several months now, there has rumored to be another enforcement action that's brewing with regard to marketing service agreements, MSAs. I have not heard anything. Frankly, I probably am not in a position to hear something about something the CFPB is about to do. But nonetheless, the next big thing that folks are interested in terms of the CFPB is their legal action with PHH. As you might recall, PHH was fined about $6 or $7 million quite some time ago. Then Richard Cordray overruled the judge's decision and wanted to instill a fine of well over $100 million on PHH. PHH, appealed that, of course, but that hearing, I believe, is April 12th, so next Thursday. So the industry is very interested in that and what the PHH has to say, how the CFPB reacts, and so forth. So that's kind of what is going on now. The CFPB, it's important for your listeners to remember that the CFPB is not they don't think of themselves as evil. They have different divisions, one of which is the Enforcement Action Division, and that's the one that garners a lot of press. But the CFPB is trying to be instrumental in making some changes in other areas. And so we'll see what happens there. Interestingly enough, when we talk about the CFPB, they are expected to do something about the situation that has come up with regard to who is liable for the mortgage on the death of a borrower, with regard to the kids and survivorship and so forth. That's supposed to be coming up here in the next couple months. But aside from that, the CFPB, by the way, which is not in charge of realtors, they are expected to kind of go as business as usual. They'll come out with announcements once in a while and enforcement actions once in a while, and so forth. They just had they've released some annual reports which are interesting. They've also tried to be consumer friendly. They're coming out with a frequently asked questions about know before you owe, commonly known as TRID. So they're coming out with that webinar here early this month. So they are doing some constructive things. I like to think that they listen to some of the criticism, whether it comes from the industry or whether it comes from the public or whether it comes from other government officials. I like to think they listen to that criticism. I like to think they incorporated some of the things that they're doing. That remains to be seen, but it would be nice to think that they they take that information and try to use it constructively. But the lending industry, and when you think about the lending industry and you think about some of just the regulatory burden that we're under, it's not just the CFPB. If you're a bank, you've got the OCC, you've got the FDIC. If you're a mortgage company, you've got all the state institutions that are coming in and doing audits. You've got FHA, or I should say HUD, you've got Fannie, you've got Freddie, you've got all kinds of regulatory bodies that are coming in and looking at you. And unfortunately, many of those regulations are overlapping. Some of them are conflicting. And so I saw a nifty chart one time from the MBA about all the conflicting regulations that are out there and all the overlap and so forth. And I think hopefully we can get some of that resolved as we move forward, because I think the feeling is among lenders that they just want to know the rules. Just give us the clear rules and we will move ahead with our business plan accordingly. And in fact, while we're at it, give everybody the same rules and let us compete on a level playing field instead of one group being governed by one party and another group being governed by another party, and one set of tax laws for one group and another set for another. like I said, I think that the industry and CEOs and companies just want a level playing field to compete. They want a clear playing field. They want the rules spelled out. They don't want enforcement actions governing them. They'd rather have clear and concise rules and regulations and go from there.
No, I agree, and dealing with the conflicting regulations is one of the hardest parts, and I've seen that, and I understand exactly what you're saying. Let me ask you this: when it comes to, there's been a prolonged below historical trend interest rates. Do you think that's driving a future inflated market? I mean, what's going to happen when interest rates start going up? What's going to happen when all the baby boomers start retiring? And what do you feel like the historical low interest rates have caused somewhat of a bubble?
Brian, can you tell me when rates are going to go up?
No.
That's a trick question. That's a trick question. I didn't mean to put you on the spot there. We've been talking about rates going up for so long, and then the Fed comes out and does it in mid-December, almost 4 months ago, and mortgage rates now are actually lower than they were in mid-December when the Fed raised short-term rates. So it's important for people to, A, keep in mind the Fed doesn't set mortgage rates, and B, they are set by supply and demand. There is a spread to treasuries, which is interesting to watch. It's pretty narrow now. The Federal Reserve has continued to buy more agency mortgage-backed securities using the early payoff money they get from their mortgage holdings, which are in the trillions. Anybody who's going to base their business model on an increase in rates has probably either been disappointed or has been negatively impacted. Frankly, the top CEOs that I talk to and the successful loan officers, they're kind of executing their business model regardless of the rate environment. And in fact, I mean, you see this as well as I do. Sometimes you talk to these loan officers who've been around for many years, and they're sitting on their porch in their rocking chairs with their corncob pipes saying, I remember when rates were in the teens and I was doing just fine. I was doing lots of loans, so forth. And the fact of the matter is, they're going to be people who want to buy houses, sell houses, regardless of the interest rate environment. So when you talk about rates going up and what's going to happen, I think that, at some point rates may go up. I'm not convinced that they are. I think that anybody who's been in buying 30-year fixed rate paper, granted they're probably hedging some of that, but there's some feeling out there that there's some value if you buy an agency mortgage-backed security and get past to 2.5% or 3%. That's a decent yield in this kind of environment. If and when rates go up, of course, the bond market will go down, prices will go down, rates will go up, and so then the question is, what's going to happen to people's business? And then the question is, well, why are rates going to go up? What's going to make rates go up? Is it because the U.S. economy is doing so well that rates have to go up in order to constrict credit a little bit to keep things from getting carried away? Or are rates going to go up because foreign buyers of our debt stop buying our debt, domestic buyers stop buying our debt, the Fed stops buying agency mortgage-backed securities? So you have to keep in mind, or have to think about, why rates would go up. If rates are going up because our economy is doing very, very well, that probably means we're seeing appreciation in the real estate market, and business is going to be pretty good. People are going to be buying and selling, and values are going to be going up. Consumers will be feeling more confident about buying a house or refinancing, buying a second home. So if our economy is doing well and that causes rates to go up, that's a different scenario than if the Fed stops buying mortgage-backed securities, or if places like Japan or China or other central governments or other overseas buyers stop buying our debt. That's a bigger problem, because if they stop buying our debt, that's a vote of, arguably a vote of no confidence in terms of our financial situation, and that's a problem. If rates go up because of that, and our economy continues to kind of muddle along, then that could be a problem. but I don't see that happening. The overseas buyers of our debt, granted, there's some ebb and flow with regard to places like China. Sometimes they're buying, sometimes they're selling. Same with Japan. Sometimes they're buying and selling, and it depends on what kind of securities that they're buying or selling. But nonetheless, the feeling is pretty good right now that the U.S. economy is doing pretty well. In some areas, you're always going to have people who say, well, no, it's not. Look at the layoffs at Amazon, or this store just closed, or that chain just shut down, whatever it is. You're always going to have that. But generally speaking, it's hard to argue with a unemployment rate around 5%, non-farm payroll numbers where they've been, hourly earnings have been doing pretty well. So our economy generally is I think, okay. The manufacturing sector has really picked up recently, and that's causing some enthusiasm out there. GDP, 1-2%, somewhere in there, is okay. Slow and steady kind of thing. It's not negative, which is nice, of course. So I think that there are people who will poke holes in the economy and say, well, what about this and what about that? But overall, I think it's hard to argue with the fact that the economy is doing okay. And so if the economy continues to do okay, and I think that it will, I think rates probably won't go down much, but I don't see them going up much either, frankly. I don't think anybody thinks our economy is going to catch on fire and really shoot to the moon, which would cause rates to go up. And then lastly, that leaves the puzzle of the demand for our fixed income securities, whether it's mortgage-backed securities or treasuries. I still think it's pretty good. There's a lot of uncertainty overseas. There continues to be interest from overseas entities with regard to buying our debt because it's safer. Some countries are seeing negative interest rates. We don't have that. Our debt is viewed as the safest in the world, so the demand is still out there. So I don't know. I think we could be sitting here in a year and we could be looking at the same mortgage rates that we are now, which isn't such a bad thing. It's hard to argue with a 4% 30-year fixed rate loan, right? So I'm not convinced rates are going to go up necessarily. I don't see them going down much either. I think my personal opinion is they'll be pretty steady for a while. And when you talk about
Good to hear. That's good. Go ahead. Sorry.
Yeah. So when you talk about interest rates and you talk about the potential of interest rates impacting value, once again, if you look at the overall economy, if our economy starts to pick up a little steam, of course, that'll mean an increase in value. But the values, when you talk about the spring housing market and what values are going to do and so forth, I think what I'm seeing out there, and I think a lot of people are seeing the same thing, is the urban cores of these areas, places like Birmingham, Nashville, Austin, Seattle, Denver, San Francisco. The downtowns are doing very, very well relative to some of the more suburban areas or rural areas. I think that's in part due to the younger folks, aged 20 to 35, wanting to live in the urban cores. They don't care about a 3-bedroom, 2-bath house out in the suburbs and sitting in traffic for an hour driving in. And so the values that we've seen really pick up have been in the urban downtown areas. The outlying areas, they've done okay. It's certainly not the same discussion that we were having 5 or 8 years ago with how much the values have gone down. But I think the urban areas are on fire. The suburban areas are doing okay. A little bit of price appreciation, but certainly the increase in value in some areas, especially the West Coast, which I talked about in today's commentary, has really led to the discussion of down payment assistance programs, led to a discussion of how can people, especially the younger generation, afford housing in some of these areas. Their parents might have moved into an area because of the school district, and then the parents like where they live, so they're not moving out of that school district. So it's like how are kids, as the newer generation, going to buy a place in that area? And I think that that's the problem, especially on the West Coast, is where are are people who have maybe 3% down or 5% put down. Where are they going to live? Can they afford the payment? Can they afford rent? And I think that's the interesting discussion. It would be good to think that builders are going to see that increased demand for starter homes. They are trying to respond to it in some areas, but in other areas they've just run out of buildable land that's any place that folks would want to live. So we'll see if builders can react to the increasing supply and demand things that are going on out there.
Yeah, and from an appraisal perspective, I mean, as an AMC, and I'm an appraiser myself, we're noticing in a lot of markets that they're very much changing the city centers. I mean, the old kind of Truman Show with Jim Carrey set up town type scenario where they have a lot of mixed use, and they're revitalizing a lot of those urban areas to more city centers with a lot of more mixed use and stuff. So I do see that happening to what you said. So, and this kind of, you may have already covered this, but I'm curious to hear your take on the baby boomers and selling and a lack of purchases by millennials. Did you see that's an issue? I mean, you covered that a little bit. Do you want to take that, or do you want to move on to something else? Is there?
Well, I have a couple millennials. I like talking about millennials. I shouldn't say I own a couple. I've got some kids, and they, so I'm not an expert in millennials, but I do observe them, and I do watch the trends. I would say that it's very interesting because the millennials have more people than the baby boom. Their influence on the economy is already being felt, and a lot of the labels that they've been given might be a little bit of an exaggeration, but nonetheless they are very closely watched and studied, and everyone's kind of wondering what they're going to do next. And in speaking with my kids and watching their friends and so forth, I would say at some point they're going to buy a house. At some point they're going to get married. At some point they're going to want that place in the nice school district. But for now, I think the median age of a millennial is 24 or 25. And Brian, I don't know what you were doing when you were 24 or 25, but it probably wasn't looking for a 3-bedroom, 2-bath house, an hour out of downtown, wherever. You were probably starting to make a little money and probably saving a little money, and having a good time, and buying a place might not have been job number one for you at that age. So I think at some point they'll want a house. Right now, a lot of them are happy with some of the multifamily, just renting someplace downtown. A lot of them don't know where they're going to work in a year or 2 or 5. They don't necessarily want a house that they're kind of tied to. Some of them are opting to get or to purchase non-owner occupied houses because they want to participate in the real estate market, but they want someplace that they're not necessarily tied to job-wise. So they might buy a non-owner occupied house where it doesn't matter where they live or work, they'll always have that income, and they can participate in the appreciation that some of the areas are seeing. So it varies. So I think they'll influence the housing market. I think on the back end of that, a lot of the older baby boomers are now retiring. I forget how many people are retiring every day, but it's in the 10,000 people a day I think are retiring, or I forget what the number is, but they obviously are influencing the housing market on the other end. They might be looking for more planned communities. They might want to be moving towards places like Arizona or Florida, or at least spending part of their year that. So we're seeing more and more of that. So it's interesting watching the demographics of the different groups change the housing market and the supply and demand functions. I don't know. What are you seeing out there?
I always think that there's so many baby boomers that the anticipation for the baby boomers to hit the market is more causing the the frustration. It's not that it's like your kids growing up and being mature. It's not that the kids necessarily are the issue. It's the the market itself wanting them to buy because there's so many of them that there's a little bit of social pressure pushed on them because, like you said, there's more baby boomers than any generation. That they're more kind of forced the issue. They're saying, okay, we need these baby boomers to start buying houses, even though they may not really be ready or at the age yet to do it.
Yeah, there is a couple facets of that. One of which is if you look at the credit report, the average credit report over the last several years, it may not incorporate some of the things that the millennial generation is doing. For example, there's been a shift away from traditional credit cards, more towards debit cards. So how, if you're an underwriter, do you have programs that incorporate that or adjust to that? You also have, a fair amount of baby boomer, or I shouldn't say baby boomer, millennials who are spending a good chunk of their income on rent. And when you have a situation like that, they may be able to afford the monthly payments of a place, but they don't have the down payment yet. So does your company, does a lender offer some kind of down payment assistance program? Does the local government offer a down payment assistance program? Are the loan officers well versed in options for people to be able to buy a place or to finance a place with a low down payment? How is the gift, is it a gift from the parents? Are the parents participating? How are loans like that underwritten? What's the investor acceptance of loans like that where there's, some kind of tweak in the financing where you've got parents or outside parties who are participating, or, individuals who band together and buy a place, some kind of tenants in common kind of thing. What's going to, what do you as a lender offer in terms of things like that can help, a little, deals like that are slightly alternative to just the traditional, husband, wife, and two kids financing a place.
Yeah, and
so it is.
There's a term, and I don't know if you heard the term. It's DINK. It's dual income, no kids.
Yeah.
And it's interesting that it was actually started back in the 1980s, and it's one of those like somewhat cyclical things that now is coming to where we have about 70, 80 people in our office, and some of them are in the baby boomer class, and that term is being more and more used. Where there are some people that are the baby boomers that have really started to make money and aren't a good option. There are some who aren't, but it's starting to happen, I think. I'm starting to see it come up a little bit. Let's go and move on to the next one. What is being done to assist the millions of borrowers who are seeking mortgage financing but are hampered because they emerged from financial crisis with credit deficiencies, especially those who received a loss mitigation option, deed in lieu, short sale, modification, debt cancellation? Can you take on that one?
I think that some of the agencies, understand that that touches on the impact of the government on lending and how much Congress, whether it's the Democrats or Republicans, want to continue to push government into helping borrowers through lending programs or withdraw lending programs from borrowers because of things that have happened in the past. It's a fact of life that a lot of people were negatively impacted by what happened in 2008 to 2010, 12. And so those individuals are now trying to come back into the marketplace. Fannie Mae, Freddie Mac, FHA, I think they have adjusted their programs somewhat. But the fact of the matter is there is some risk there. And you could say, well, that, that wasn't their fault that they weren't making their payments. It wasn't their fault that they were foreclosed on. they might have been put into a loan program that they shouldn't have been in, or maybe they bought on speculation and the market really took a plunge as it did in many areas like Phoenix or Las Vegas. So you have different scenarios, different things playing out. It's not kind of a one-size-fits-all. When you're a Fannie Mae or Freddie Mac and you're dealing with credit risk, as are companies like Wells and Citi and Chase, others, U.S. Bank, when you're dealing with credit risk, it's hard to make a one-size-fits-all decision in terms of extending credit to individuals who have had a foreclosure or short sale in the past. There is continued, like I say, there are more and more of those people who are trying to get back into the housing market and borrow money. There is some feeling that, gee, once bitten, twice shy. These guys have, they have a history of this, so we need to be careful. I think that as time goes on, I think that the agencies and investors will open the doors more to individuals who have been negatively impacted by events in the past. But it's not going to be ignored. If you've had a foreclosure or short sale in the past, it's really hard to ignore that situation because obviously there are millions and millions and millions of people who weren't foreclosed on and who didn't have a short sale. So I think that the attitude and the atmosphere is changing, but it's going to take some time. And as I said, you just can't ignore the past when you're making a credit decision like that. Does that answer that? Brian, you still there?
I'm here. Sorry, I had myself muted. That was.
Okay.
I had myself muted.
It's like, hello, I'm alone. What's testing? 1, 2, 3.
Exactly. Where do you see the non-QM market headed in the second half of 2016?
I'm sorry, Brian, you cut out there. What'd you ask?
I said, where do you see the non-QM market head into the second half of 2016?
Well, that's a good question, because as we were leading up to that whole QM versus non-QM division in our industry, and just here's a reminder, people shouldn't think of non-QM as subprime. There were some people out there, some supposed experts, who said, wow, non-QM is going to be billions of dollars every month. It's going to be, it's really going to ramp up. It's going to be a sizable proportion of our business. And that has not happened. Lenders have continued to do very well, offering primarily a QM lineup. There are investors and lenders who do offer non-QM product, portfolio product. The banks, you can get non-QM lending or non-QM loans through a bank that goes into their portfolio that's not put out into the secondary market. But generally speaking, the companies that have made a reputation for their names on the non-QM side, like Luther Burbank Savings or B of I or Citadel Servicing, some of those companies are doing pretty well. But if you're an A-paper, pure Fannie, Freddie, FHA, VA, USDA, with a few bond programs thrown in for good measure, who are doing pretty much all QM loans, you've seen three big hurdles to non-QM loans. The first is reputational risk. Do you want to be known as a non-QM lender? So there's that. There's a reps and warrants. There's still perceived worries about the reps and warrants with non-QM loans, and so there's that fear. And then lastly, there's a sales. It's a different sales technique to talk to a borrower about a loan, and that borrower's heard, their friends and neighbors are out there getting 3 3/4 or 4% 30-year fixed rate loans, and so they come in and they're looking at a particular program, or because of their profile it's non-QM, and they are told, well, your rate's going to be 7 or 9%. And so if you're a loan officer dealing with a borrower who's in that kind of situation. It's a tough sales job. It takes work to give somebody a 7 or 9% loan in this kind of environment, and explain the whole difference between QM and non-QM and so forth. So there's some big hurdles out there for lenders who seem to be doing enough business on the QM side. So with regard to non-QM, I don't know if the industry is quite needed non-QM. Interestingly enough, Fannie Mae and Freddie Mac, there are some changes that take place in a couple of years with regard to DU and LP and QM versus non-QM. So we'll see what happens then. It also kind of coincides with when Fannie Mae and Freddie Mac are supposed to come out of conservatorship, so that'll be something else we can think about. But the QM lending that I think the experts were talking about taking off has not happened for a couple of different reasons. So, we'll see what happens. It's out there. If somebody really wants a non-QM loan, they can find it, just like if somebody really wants a jumbo loan, so they can find it. There are programs out there. The pricing or some of the underwriting guidelines might not be ideal for some borrowers or some lenders, but the programs are out there. It's not like they're against the law. But with regard to non-QM, it just hasn't taken off as much as some of the experts thought it would. But it's out there. Companies are doing it.
Yes or no question. Do you think the GSEs will be taken out of conservatorship? Yes or no? Yeah.
Yes or no?
Yes or no? Well, man, maybe not. I don't know. Maybe that's not a good question. Let's move on.
So they, Congress. It's like the debt ceiling, or it's like some of the things that they impose on themselves. When it comes time, when push comes to shove, and they need to, adjust the budget to conform with whatever they're trying to do, and then they just change the ceiling. They change the debt ceiling. They just keep raising it. So in 2018, the Fannie Mae and Freddie Mac are supposed to come out from under conservatorship. I don't know if we're any closer than we were a couple of years ago. The industry continues to do things that would influence or may influence that. But in terms of Congress actually making a hard decision, you can't really look for anything this year, and then next year there'll be some activity which we'll see. But I think the move is more toward combining the two, merging Fannie Mae and Freddie Mac. And going from there, I think the NBA and some of the other institutes of NAR are very instrumental in trying to move ahead with some of the changes that Fannie Mae and Freddie Mac are making, and they have made some very good changes recently. They're certainly becoming more like-minded in terms of some of the guidelines, some of the policies and procedures and so forth, which needed to happen. So that's good. I think the NBA is doing a good job on that. I think that eventually they will, because there's really the government shouldn't own Fannie Mae and Freddie Mac. I mean, conservatorship is basically a nice way of saying own, and so the government really shouldn't be in that position. So I think at some point they will, whether they come out and they're separated, whether they're still Fannie Mae and Freddie Mac, or whether they are different entities or the same entity, whether they're combined, that remains to be seen. I think we'll see some changes there. Could very well be that we combine these two, which would be interesting. Maybe the world doesn't need both Fannie Mae and Freddie Mac. So we'll see. But I'm not worried. I don't think anything that's going to happen is going to negatively impact lending. I don't think Congress or the NBA or the National Association of Realtors want to do anything that negatively impacts the ability for a borrower or a buyer, more specifically a borrower in this case, to obtain financing to buy a home. I don't think anybody wants that. The question is how we best go about it. So I see them coming out at some point, but it's going to take a while. It's going to take a lot of hard work.
Understood. 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 All right. Well, thank you, sir. Now I have some appraisal questions that I can kind of take over that.
Yeah, you could probably take those. You know, to sum up the whole gist of this, with regard to spring and you know, the housing market, I'd say the housing market is in decent shape in a lot of areas. We've had some hard winters, but you know, values have started to do nicely in some things, and the question is whether there'll be listings, and we'll see. But certainly, spring has sprung.
Well, there you go. There you go. And then when it comes to the appraisals, there's definitely a lot going on when it comes to the appraisers regarding what we're seeing from our clients. Obviously, everyone's well aware of the AAD. FHA is adopting similar regulations to what Fannie has done with the SSRs and UCDP. So if you're a lender, we've been actually just starting to really run some live ones, and we have a couple lenders signing up for the EAD, which we sent out in our newsletter on how to get us signed up for that. Collateral underwriter is becoming more and more of a topic when you look at what's going on with the GSEs and how they're drilling down on appraisals. And because of that, we've seen a lot of our clients hire chief appraisers. Before, if you look 5, 6, 7 years ago, very, very infrequently would you see a national lender or a local lender having a real appraisal department at any significant level, and that has changed in a big way. Almost every single one of our clients has either hired a chief appraiser or put in a chief appraiser, and it's something that the regulators have really requested. We have one of our clients that they're a top 50 lender, and you know, they had a lot of controls in place. They were using multiple AMCs, and they have a really good process in place. And one of their investors and one of the regulators came and said, you gotta beef up your appraisal department. You gotta take the appraisal process the same way that you have the underwriting process, and that you do have to have a bigger department. Some lenders are really good about it, some aren't. But what I have seen that, and then what I've also seen kind of through the grapevine and through things, is that the appraisals are going to be more and more of a regulatory compliance issue this year more than ever, where the auditing has, or the lenders that have gone through audits have more or less seen appraisals not looked at as in depth. That I've heard is going to change, you know, from a variety of people, and that they're actually going to be looking at appraisals more and more frequently, more and more significantly, and really looking to make sure lenders have processes in place to handle appraisals and that they're reviewed properly, etc. So that's it. If you have any more questions, you know, we thank everyone for joining us today. You know, Rob and I, you know, appreciate it, the opportunity to present to you guys, and thank you for being a valued customer of Coester VMS. This webinar has been recorded and will be available on our YouTube panel, our YouTube page, probably within a couple hours, and we will always send it out to everybody just so you can go over on with your team. Thank you, and everyone have a great week.